Welcome to the Explainer. You ever look at a stock's price and just wonder, is this thing actually a good deal? Well, today we're decoding the PE ratio. It's one of the most famous numbers in finance, and it's the tool Wall Street uses to start answering that exact question. Right? It's the big question for any investor. A really high stock price doesn't automatically mean a company is great, and a low price doesn't mean it's a bargain. We need a way to cut through all that noise, to measure the actual value. And that, right there, is where the PE ratio comes into play. So here's our game plan. We'll start with the big idea, the price of profit. Then we'll decode the ratio itself. We'll look at how it helps us read the market's mind, see it in action out in the wild, and then cover its major blind spots so we can build a much smarter, more holistic view. Okay, first things first. Before we jump into any of the math, let's talk about what the PE ratio is really, truly measuring at its core. I want you to think of it like this. Imagine a company is a machine that literally prints money. The PE ratio, that's the price tag on the machine for every single dollar it prints each year. So if you see a PE of, say, 20, it means the market is willing to pay $20 today for just $1 of that company's annual profit. It's the price of profitability, plain and simple. So how do we actually get that number? Well, the PE ratio is built from two really simple parts, but believe me, when you put them together, they tell a powerful story about a company. It's literally just the stock's price divided by its earnings. Now, the price part, that's all about market psychology. It's investor hopes, it's fears, it's all the expectations wrapped up in one number. The earnings part, that's the reality. That's the actual profit the business is kicking out. And this is what makes the PE ratio so cool. It's a direct bridge between market hype and real-world performance. And just to be super clear, that E isn't the company's total giant profit number. It's the earnings per share, or EPS. You basically take the company's net income, you pull out any dividends that go to preferred shareholders, and you divide what's left by all the common shares out there. It's the slice of the profit pie that belongs to just one single share. All right, so we've got the number. But what does a PE of 10 or 20 or even 50 actually tell us? Well, it's basically a window into what the market is expecting from that company's future. So a high PE, that suggests investors are feeling pretty optimistic. They're paying a premium right now because they're betting that earnings are going to grow and grow fast. On the flip side, a low PE can mean one of two things. Either the market is being cautious, expecting slow growth or maybe some extra risk. Or, and this is the exciting part, it might just be an undervalued bargain waiting to be found. Now, you'll see analysts use two main flavors of PE. Trailing PE uses the last 12 months of actual, real earnings. It's a fact, but it's also history. Forward PE, on the other hand, uses estimated earnings for the next 12 months. It's way more relevant because investing is all about the future, but it's based on a forecast, and forecasts can be wrong. So it's a classic trade-off. Do you trust the proven history or the promising guess? Okay, let's take this out of the textbook and into the real world. How do analysts actually use this thing to make real decisions? Here is the single most important rule when you're using the PE ratio. Context is everything. Comparing the PE of a slow and steady utility company to a high-growth tech startup, it's completely meaningless. Their business models, their growth potential, their risks, they're from different planets. This ratio is only useful when you're comparing apples to apples, companies in the same industry. So let's say we're looking at two direct competitors. AB Group is trading at a PE of 5, while its rival, CD Group, trades at a PE of 8. What this tells us is that the market is willing to pay $8 for $1 of CD Group's earnings, but only $5 for AB Group's. There's a clear valuation gap right there. So the immediate gut reaction is to say, well, AB Group is the bargain. But is it really? See, the PE ratio doesn't actually give you the answer. It just tells you what the market is thinking. The real work of an analyst is to figure out why. And that's because as powerful as this ratio is, it has some pretty serious blind spots. And understanding these is what separates a beginner from a real pro. First up, its biggest mechanical failure: if a company has zero or negative earnings, you just can't calculate a PE. The math doesn't work. This means the ratio is completely useless for a massive part of the market, like all those early-stage tech or biotech companies that are burning cash to grow and aren't profitable yet. Second, that earnings number can be tricky. A company might sell off a factory one year or get a big one-time tax break.
That'll inflate its profit for a little while and can make the PE look artificially low, creating a false buy signal. A smart analyst has to dig in and find the real, normalized earnings.
And third, and this is a big one, the PE ratio completely ignores debt. It only looks at the value of the company's stock, not its loans or bonds. This means a company might look cheap with a low PE, but it could be hiding a mountain of debt that makes it incredibly risky. This is exactly why professionals never, ever use the PE ratio in a vacuum. To value those unprofitable companies, they'll use something like EV to sales. To account for debt, they use a metric called EV to EBITDA, which looks at the whole company. And to check if a high PE is actually justified by growth, they use the PEG ratio. So, how do we wrap this all up? Well, we learn to treat the PE ratio not as the final answer, but as the starting point for much deeper investigation. A pro analyst might use a simple three-step framework. First, normalize. Find the company's true sustainable profit by stripping out all those one-time weird things. Second, contextualize. Use a tool like the PEG ratio to see if the company's growth story actually justifies its PE. And third, neutralize. Look at a metric like EV/EBITDA to see the full picture, debt and all, so you get a truly fair comparison. And really, that's the key takeaway here. The PE ratio doesn't tell you if a stock is a good investment. It tells you what the market believes about that stock right now. Your job as an analyst is to use it as a starting point, to ask the right questions, and to figure out if the market's belief is right or if it's dead wrong.